Recording. Hey everybody, this is Josh Nelson from Keystone Financial Services. Just getting started here with some housekeeping items. I'm here with Jeremy Busch, our wealth advisor. And today we're basically going to be covering a lot of different areas with regard to the economy. And as we get started, a couple of housekeeping items. First of all, you should be able to see us, which is great. You should be able to hear us now that we turned off mute. And then also want to make sure that you understand that we are trying to be interactive. Although we can't hear you right now and we can't see you right now, we can see your questions and we can see any feedback that you give us through the chat feature. So definitely locate those things in the GoToWebinar toolbar, because I think that'll be useful not only for yourself, but also for others that are attending. It could even be people that are watching this recorded later. But again, those of you who are watching live, you get the benefit of hearing not only what we're talking about here live, but also the ability to interact with us. So please take advantage of that. We'll give it just a couple more minutes and get started. All right. We got 11:59 on the clock here. We'll start right at noon. And we know that people are really busy, by the way. And so when we do these, we want to make sure, especially when we're doing it as a podcast or a webinar, that we're concise. So we definitely want to respect your time, and we'll answer questions along the way. But keep in mind, you can always contact us. We're really easy. It's Jeremy@KeystoneFinancial.com and Josh@KeystoneFinancial.com if you've got email conversations, questions, things like that that you want to get started after the presentation. So I hear noon. I see noon on the clock here, so we're going to get started. We do know that at least twice as many people watch these webinars after the fact. So we do post these on our YouTube channel. By the way, I want to make sure that you're aware of that. If you just go to our channel link at KeystoneFinancial.com, you can actually go out there, click on the YouTube link, and that'll take you to our YouTube channel. For compliance purposes, it won't be available right away today, but a few days later, we do post it, and all of our archived presentations are out there as well. So please feel free to not only watch those yourself, but please feel free to share them with people that should be here today. So with that, we'll go ahead and get started. A couple of housekeeping items. Again, we've got the chat feature and we've got the questions feature. So please make sure that you're using that along the way. We do want to respect people's time, so we definitely will keep things moving along. If we're spending too much time on one area, in other words, we may have to catch some of those questions offline and contact you afterwards. So we'll definitely keep things clicking along here and be done by 45 minutes to an hour. So with that, I'm Josh. This is Jeremy, our wealth advisor here at Keystone, and we are your hosts for today. So we're going to be visiting about a lot of stuff with the economy and the market. And sometimes this stuff can be pretty dry, but we will do our best to keep it entertaining and also certainly interact with you along the way. Keystone's been here for about 9 years. We just hit our 9-year anniversary, and I feel pretty good about that, actually, because we're one of the very few companies that actually make it that long. In fact, they say that only 4% of businesses make it 10 years from start. So that's a good thing. We're actually going strong right now. So I'm very confident we will make it to year 10.
We're gonna have to throw a big 10-year party.
Yes, yeah, we will for sure. So hopefully you're all invited. Maybe we'll make some virtual way for those of you who don't live in the area. We'll make some virtual way for you to celebrate with us as well. So, but yeah, we're located in the land of love, Loveland, Colorado, right here in the Keystone Financial Building. So it'll be fun to be able to talk with you today and to share some insights, really some things that we're seeing and some things that really you should be thinking about for the future with regard to how you make your decisions about your money. So next slide here, we do need to stay on this for a second because this is basically just Jeremy and myself, our opinions, right? So we're giving you some stuff that we're seeing, basically some stuff that we're seeing from other experts out there, that things that could be happening and things that you should be aware of. But everything is just our opinions, and of course we can't guarantee anything. So that's what this slide means, and I appreciate you taking the patience to read that. So we're going to go over 3 main areas today. We always have the same format, by the way, where we've been, where we are, and where we may be going. So we're going to take ourselves off of the camera here for a bit and go through the material. So we will start here with where we've been. And the good news is that that's been a good place. We've actually had a great year. I think by most people's standards, it was a really great year with regard to the US market in particular, but really it was kind of hard not to make money. when you look at 2019, there really wasn't much that went down. In other words, unless you were really concentrated in one particular area or one stock maybe that went down, really bonds went up, oil, gold, really everything went up quite a bit. So it was good time to be an investor. Now the S&P 500 actually went up a lot faster than everything else, as you'll see here in our chart. And it really is a tale of two markets, where you look at 2018 and it was really a year where you couldn't really make money in anything. Everything was down, right? So it was like even a diversified investor, you would have been down in value. And then 2019, it was kind of like you could do no wrong. So kind of interesting, because oftentimes we end up seeing diversified portfolios actually not be so correlated. You're always going to have certain pieces that aren't doing the same thing as the rest. That's a good thing. That's why you always want to have different asset classes. And in particular, you want to have some things even in your portfolio that might not be looking good right now. You might see those things going down, but that's one of the ways that you know you're diversified, is that you want some investments that are going to zig while others might zag. So looking at global stock markets, Jeremy and I had people invested in all these countries, right? Not really. So we had Russia, Greece, Egypt. How many people actually would have invested in those markets? Well, maybe a little bit, right? You might have a piece of your emerging markets exposure or something like that. But one thing that most of these countries have in common, the top three for sure, Russia, Greece, and Egypt, is that they're pretty volatile. They're in volatile areas of the world. And so you did see a pretty strong bounce here in 2019. Of course, the U.S. market, I think of as kind of the market that most people, if they were diversified, that was probably the piece that they owned that made the most money. But you can see that down there on the end too, there are certainly countries that would have seen a decline in value. And the trick is that nobody knows from year to year. And a lot of people try. In fact, a lot of people make a lot of money and they get paid a lot of money, I should say, to try to outguess this stuff. But it's pretty tough. And when you're investing in some of these markets like Argentina or Russia, that would be a really, really high risk. If you had any exposure to those things, we do recommend that those would be pretty limited. We like the U.S. We like the U.S., but we still like to have some international holdings in people's portfolios because it is good diversification. And really, the U.S. is rarely the top market in the world. In fact, it's very rare that we see the last couple of years where the U.S. really outperformed everything else. What that kind of tells me is that we might be in for a shift, right? We could be in for a shift where the other markets start taking off and maybe start outpacing the U.S. So, people are not always rational, and you can read the cartoon here. Today, stocks dropped on the theory that the higher stocks rise, the greater the chances they will fall. And, we might laugh about that, but Jeremy and I hear that from people all the time, various ways of saying, well, gosh, how long can this last? Doesn't the market have to correct here pretty soon? Doesn't it have to go down pretty soon here? And so people are a little bit nervous, I think, when we're seeing the market hit all-time highs. Sometimes people kind of look at that as being a risk and are afraid that maybe we're at an all-time high and in for a big, big drop on the other side. Now, of course, we can't guarantee anything again, but as we go through here, we'll talk about why that might not be true. So we pay a lot of attention to psychology because we think 80% of financial success, investment success over time, 80% of it is just psychology. In other words, it's people's behavior. It's the decisions that people make with their money, whether it be where to put their money, where to spend their money, when to sell investments, those sorts of things. As logical as we might all feel like we are, the average person reacts emotionally to a lot of stuff, and it ends up resulting in not so good results over time. And that's because we're limited by our own biases, right? And we're not going to go through each one of these. This would be a whole seminar, right, if we just talked about financial psychology and so forth. But in a lot of cases, you might kind of find the information you're looking for, and it's never been so easy as just going out on Google or YouTube to be able to find an opinion that you're kind of wanting somebody to confirm, right? In other words, if your viewpoint right now is that the world is a terrible place and The economy is not in a good place, you can find somebody, I guarantee you can find some strategist or some economist that's going to say, well, the market's going to drop next month or next week, or it's going to be a terrible year next year, or if the election happens this way or that way, here's what's going to happen. Well, it's not that easy, right? There are so many decisions out there that are being made on a day-to-day basis, and so many things that we can't predict, right? Right now, we're sitting here in February of 2020, and the coronavirus is, had a big outbreak in China and is spreading to other parts of the world. Who knows how bad that'll get, but has it had an impact, especially on China? Well, yeah, economically, it's having a huge impact, and certainly it will globally as well. But even if we had predicted, knew all the different economic information out there as far as earnings and unemployment, if we got all of those things right, and nobody ever does, of course, how do you know when stuff like that is going to happen? A terrorist attack or a disease or something else that just comes out of the blue. Bottom line is that there's always stuff out there that we don't know, and that's why, as Warren Buffett would say, it's pretty impossible to actually time the market over time. People can get lucky, but it's pretty unlikely that you'll continue to be lucky. And in fact, in the financial crisis, there were a few lucky investors out there that kind of made calls. There have been movies and books created, right, as a result of it. And they were lucky, but if you look at their track record since the financial crisis, most of them have not been able to repeat that success as far as knowing where the markets are going or when to be in or out of the market or certain areas. So we think it makes a lot more sense to focus on the stuff that we can control instead of the stuff that we can't control. And that, more than anything, it's really basically your goals, right? It's your financial goals, your life goals. Be thinking about your family and what you're trying to accomplish. And of course, we can translate that into numbers, right? And we do that as we do our financial planning with clients. But it really is just about your goals. It's about what you're trying to accomplish, what's important to you. And as good financial advisors, it's our job to ask those questions and get a really, really clear picture so you understand and you're less likely to be thrown off, because the results are disastrous. If people invest emotionally, it results in them missing out on a lot of not just bad days, but also a lot of good days, right? If you were trying to time the market, you may have jumped out at a certain point. And let's say, for example, you were the luckiest person in the world, and back in, say, 2007, before the market started dropping, the Dow was somewhere in the 13,000 range at that point. Well, what if you were just the luckiest person in the world and you got out right before it dropped, right? I think the Dow ended up dropping about to 6,600 or so. And now we're sitting about, what, 29,000 or so?
Yeah, just over.
Yeah, 29,000 on the Dow. Well, that would have been a lot of gain that you would have missed out on unless you had been lucky twice, right? You would have had to have been lucky on when to get out, but also lucky on when to get back in. And of course, along the way, you could have had other premonitions, right? That, oh, it's time to get out again. And then you would have missed out on a lot of upside. So you can see on the chart here, when you miss out on good days, you don't have to miss very many of them, and you end up just killing your return over time. One study that Morningstar has done, and others will kind of substantiate this. We've seen different studies on this, but Morningstar's run the numbers, and they can actually show when investors are putting money in or taking money out of the market. And sadly, over the last few decades, the S&P 500 has averaged about 10% a year, but the average investor has gotten less than half of that. In other words, in the same stock market, we're not talking about different markets or something like that. In the same stock market, the average person has actually made less than that, and they've attributed it to timing, the fact that people have tried to time the market, and so they end up missing out on enough of those best days that they end up seeing really, really bad results. And some of the studies actually substantiate that it's so bad that people might as well just leave their money in bonds or even cash, leave it in the bank, versus trying to time the market, because they'd actually get better results. So one thing to just keep in mind is that reacting emotionally probably will do one of two things. It'll probably cause you to be really greedy during a time like this, right? When the market's very high, people might be piling on the risk. And then on the same notion, when people are taking money out of the market, it could be at those lowest points when that could be the point where you'd be getting the maximum opportunity. So again, really focus on financial planning, focus on what your investment objective is. We've actually got a great tool, an assessment that we send out to clients. And if you haven't done that for a while, we definitely would recommend that. We can send that link out to you. But what that is, it's our risk-alize analysis. And what it tries to do is it tries to kind of predict what you would do in various circumstances. So we can figure out, well, which one of these people are you, right? And it's not just about age, it's also about investment objective. We have clients that are in their 70s, 80s, 90s even, that have an objective of growth. They really want to grow their wealth at that point, because they might even see it that, hey, this money is not all for me. This is actually going to be passed on to kids or grandkids, or maybe even to charity. So they still see that they have a growth objective. Versus we might have some younger clients that are very conservative, and it makes them really nervous when they see the market bounce up and down, and they really don't want to see as much variability in the values that they see on their statements. So they might actually have a long time horizon because they're so young, but they might have an objective of really just trying to conserve and to just try to earn a little bit of return off of their money. So it's our job not only to figure out how old you are and maybe just kind of a back of the envelope calculation, it's also really doing some more thorough analysis, because the points where we can be, I think, the most valuable are when the market is at its all-time highs or all-time lows, when people are more likely to make those behavioral mistakes. So there are good reasons that you can make changes to your portfolio. One of those is that your goals have changed. So, kind of back to our last points, that might make you think, well, that means just never sell anything, right? Just stay in the market and never sell. Well, not necessarily. There are a few reasons why you might want to, right? There's a difference between buying and holding and just buying and forgetting, right? We don't think buying and forgetting is a good investment strategy. We think that it's good to reevaluate what you own and reevaluate your goals over time. So if those have changed, and sometimes they do, right? Sometimes people may say they're going to retire at a certain point, or pay for a certain amount of kids' college, or maybe buy a home in the mountains. Whatever your goals are, those do change over time. Jeremy and I have hundreds of meetings per year with people. We can tell you that just about every meeting, we kind of tweak stuff, right? We tweak things not because we think they should, but just because people's objectives have changed. So your risk tolerance has changed. Sometimes that happens. Sometimes people go through a major life event, or something else happens where they really feel like, I've got to make a major change here because maybe I'm not taking enough risk and I'm not going to hit my objectives. So I'm willing to take on more risks so I can raise my odds. The other side of things too could be that maybe people were too risky. They didn't realize that they own some investments that could drop, like sometimes they do. And oftentimes we see this when people have over concentrations in certain things like company stock, or maybe too much in a piece of property where all their money is just in one thing. And we all know that old adage of not putting all your eggs in one basket. So we agree with that as well. We want to make sure that, we're your head coach, right? We're helping you through the all the ups and the downs, but at the end of the day, it's very important that you've got your risk spread out. So it's time to rebalance. Certainly rebalancing, there's been studies that have shown that rebalancing actually will help enhance your return over time, and can help you not get too high or too low of risk, as different asset classes do change over time. Better opportunities, sometimes that happens. Certainly the markets are dynamic, and sometimes we have better portfolio managers, or we've got things that are less cost or more liquid. So we always want to be identifying opportunities as people that are good stewards of money. And then finally, fundamentals have changed. Sometimes just fundamentally, there may be a shift in the economic environment that warrants making some tweaks to somebody's allocations. But as we saw before, having a knee-jerk reaction where somebody is just taking all their money out of investments and putting it in cash, or vice versa, over time, there's nobody that I know of, and I challenge somebody to find the person who can do it consistently, because Warren Buffett says that he's never met anybody, and the guy's 89 years old, right, and one of the most successful investment managers ever. And he's even saying he's never met a person who can consistently time the market. So definitely like to use Warren a lot for quotes, things like that, not only because he's been successful, but he's got some principles that really don't change. And then, finally here, looking at fundamental analysis, what we want to look at is earnings, not just looking at price. And sometimes people get too focused on where the market is as far as price when we hit all-time highs. Well, we like to look at earnings as well, because really that's all that a company is worth to begin with, is just its earnings or its profits. Same thing. So if a company is profitable and we expect a company to become more profitable in the future, then the overall market probably will do something for us. It'll probably cause the price to increase because people are willing to pay more for those potential earnings in the future. Vice versa, though, if we think those earnings might be impacted on the negative, and that could be lots of different things, right? There could be things that are just specific to that company, but maybe it's overall shifts in the economy. It could be something that's political, right, where tax rates are going to go up or something like that, or regulations could increase that might affect a particular industry or a particular company. So we do want to look at that, and really earnings over time are important to look at relative to the price of the market or the price of whatever you own, as well as their dividends. The dividends are just the portion of the company's profits that they're distributing out to investors. So Peter Lynch, some of you may remember Peter Lynch if you've been around for a while. Peter actually was the manager of the Fidelity Magellan Fund. And at the time, that was a really hot investment, a hot mutual fund back in the 80s. But it's interesting that he actually says that more investors have lost money by preparing for corrections. In other words, getting scared and saying, hey, let's pull money out, wait till things get better or things stabilize, than have actually been lost in corrections themselves. And Jeremy and I have been around a long time in the financial industry. We can tell you that's true. can tell you that people that try to do that, they just can't do it consistently. So probably you're catching a theme by this point that we're not recommending that people try to be the hero and try to outguess the market, because it's just not possible to do that consistently. We like to focus on the things that we can control, not the things that we can't control. So bond markets actually did surprise investors in 2019. I was surprised as well in that the Federal Reserve, you might remember in late 2018, there was a lot of uncertainty around the Federal Reserve and what they were going to do with interest rates. In fact, they were actually saying that they were going to raise interest rates in 2019. It turns out that caused a big correction. We saw about a 20% drop in the US market in that fourth quarter of 2018, largely as a result of the Federal Reserve statements and maybe some uncertainty that created in the minds of investors. So the interesting thing is that we thought that that would happen, and it turns out that they actually reversed course within a few weeks and said, no, we're not going to raise rates, we're actually going to lower rates. And that's what actually happened, is that there were several rate cuts then in 2019. And from what we can see right now and listening to the experts, that the Fed probably is just going to sit pat for the time being, leave rates where they are. Inflation doesn't seem to be a problem right now, and so they probably don't feel compelled to get aggressive on lowering rates or raising rates, just leaving them where they are for right now. But we'll see. If inflation were to tick up, it's possible that they would start raising again. And then there's a few things in the market that certainly were, the bond market was impacted. One of those, again, is the Federal Reserve cut rates. And one thing that people oftentimes get confused by is they're not sure why the bond market reacts the way it does. And although it's not limited to just one factor, one major one is interest rate cuts. If rates go down, that tends to have a reverse effect on the price of bonds. In other words, if rates go down, prices go up and vice versa. So keep that in mind. We actually did see an inverted yield curve in the US for a short period of time. That means that even though you would think this would never happen, because if people tie their money up over time, we talked about this at our halftime report, if people are willing to tie their money up for a longer period of time, say if you went to the bank and got a CD, you would expect to be paid a higher percentage on that CD if you committed for 5 years versus 3 months, right? Well, the same thing happens in the bond market most of the time, but when we have an inverted yield curve, basically means that short-term rates are actually higher than long-term rates. And sometimes that's actually a signal. It's not a perfect signal by any means, but sometimes it's actually a signal that we could be headed towards a recession. I think most economists right now would say we're certainly not in a recession and not likely to have one in the near future. So, and finally, overseas, they've gotten actually to the point where rates have gone down so low that they have negative yields on debt. There's $17 trillion estimated right now in negative yield debt. Interesting, some people are saying that the US will end up in that spot eventually. But again, something that is something to watch. It certainly can have an impact, not just on bond prices or rates, but also people's confidence in the future. So we've had this long bull market in bonds, and it might not feel that way, but when you look at it over decades, this is going back to the 60s, you can see that we topped out in the early 80s, actually, when inflation got really high. The Fed raised rates through the roof. And then since then, because that broke inflation, and inflation rates came down. What's been happening as a tendency since that point in time is yields have gone down, down, down. It's actually driven the price up on bonds in general. So if you're a long-term holder of bonds, you might even be saying, hey, this has been a great investment over time. And I would say you're probably right. You're probably right. But can this last forever? Is it possible that rates will keep going down, down, down? Well, they can, especially if we go to negative yields. It is possible, but I think it's probable that we're closer to the bottom than we are to the top at this point in time. So with that, I'll hand it over to Jeremy.
All right, thanks, Josh. So where are we now? Well, I'm sure if you don't know already, you will be very much aware that it is a political year. It's 2020 is an election year, and so a lot of people are swaying one way or the other. I know there was a State of the Union address the other night. There was a lot of stuff in the news about that. No matter what side of the aisle you're really on, really it just causes a lot of, I think, short-term chaos, really. So really what it is a lot of the value also that I think we bring to this is pulling out the noise from what really affects things, right? And so when we think about things that are happening in the world that are truly affecting your money and your investments, first and foremost, we're going to look at central banks and what those policies are doing. And so you can look, there's really kind of a mixed bag on here. And the important thing is what this slide shows is that there's a lot of stimulus happening, especially in South America, in Europe, all those little blue areas. That's areas where monetary easing is happening. So interest rates are dropping. These central banks are making it easier for people to borrow money, industry as well. And then when you see things like the red or the pink or whatever color you want to call that, that's where it's tightening up. Maybe things are getting a little bit too inflated, and so they need to tighten things up. The important thing to know on this is even within the last year, you can see America right now is kind of at that nice little light blue area. That was pink about a year ago. And so these things shift. And so the central banks are constantly adjusting these rates depending on what is happening outside of their countries as well as inside of their countries. So definitely things that take effect there. If we look at kind of economic growth estimates right now, we see definitely a lot of these have dropped down a tick or two from where we would think, but the important thing to realize is that these are all still very much positive. You even have 0.4 down in Japan, way down there at the bottom. Definitely some easing off of things. I think North America this last year, we were just over 2. Right now, it's this estimate, according to the economists in the world in 2020, is 1.6. Depending on who you're talking to, that can, I've seen as high as 1.9. But the important thing, again, to remember is maybe a little slowing down, but still very much in the positive. A lot of strength left in the economy. Whereas if we came to you, last year and said, hey, everybody, I think we should put a lot of your money in Guyana or maybe Syria, I think we might have gotten laughed off, laughed right out of the room. Yeah, right. Say, hey, let's put some money in Syria. I bet we're going to have about a 9% return there. I think, honestly, if you look at this list, save for India way down at the bottom, that's the only major economy even on this list. And so Josh mentioned this earlier, really it's not about where the biggest growth is going to come from, it's about diversification. Are we going to put all of your money in Bangladesh or Rwanda? Definitely not. Might we have a little bit of it there in international emerging markets? We very well could. It would be good to have a little bit of everything, right? And so that one just kind of goes to show it's not always the fastest growing places that you really want to be in, but definitely to own a little bit part of them. And so again, trying to pull out the noise from what actually matters. This is one that's not getting a whole lot of news right now. I imagine being an election year, this will probably begin to take a little bit more focus, but the national debt overall. And now when we look at this slide, I would look more at that line that's going above the bars than the bars themselves. So overall dollar amount, yeah, there's about a few $1 trillion being added to this pretty regularly. But really what it comes down to is the percentage of GDP. So right now you can see we're just under 105% of GDP, which what we tell our clients all the time is, live within your means, right? Make sure that what is coming in is more than what is going out. And quite honestly, right now inside the United States, what is going out is more than what is coming in. You can see now this does go out to 2024. So we are actually about the 5th bar in from the right currently. And so what this is projecting actually is you can see it's starting to downtick a bit there. And a lot of that is because in 2021 is when a lot of these new trade deals are actually starting to take effect. And so there are projecting out that that will definitely help out with the imbalance between exports and imports and should be getting us on a little bit better ride. But that is definitely something that we're looking at. The important thing to remember as well in this is this right now is looking at US GDP. What it is not showing, but is also a factor, is that this is not just a US issue. This is actually global. This is happening in a number of countries around the nation and around the globe. And so really, this is something that we're going to be keeping an eye on, national debt. In addition to that, corporate debt is also kind of taking the same route. Now, corporate debt is actually working on a slightly different reason for that, really. The reason being for a large part of this is, things like trade tensions, political years. It's not that the companies don't have the money to be investing themselves, but the fact of the matter is one, a lot of CEOs are taking a sit back and wait mentality right now. And so what that means is they're saying, I don't know where we're going to end up in the midst of all these trade deals, and I don't know who might be getting elected this year. And so really what they're doing is they're sitting back and they're saying, well, let's think about this. Why should we leverage our money when really debt levels and ways of borrowing are super, super cheap right now? And so that's kind of the way that they're going, is that it's super cheap to borrow. So they're even kind of taking advantage of that. So it's raising that debt level up a little bit, making them look more leveraged. But at the same time, they also do have the money sitting there. So it's not necessarily a terrible over debt type situation that corporations are finding themselves in. So again, now that we have this slide in here just kind of to prove a point, right? That you look at all these little points on here, and yeah, for a short time, North Korea tensions, US-China trade tensions, those definitely do cause some volatility, okay? And they do hold real impacts. One thing that's not on here that we literally just felt this last week and this week is coronavirus. Couldn't have predicted that one. Market on Friday, I think, dropped, 600 points? The Dow did, 600 points on Friday. And then between Monday, Tuesday, and Wednesday so far this year, I think it's up about another 700 from there. So just a lot of really short-term volatility. How much does it actually affect your investments? In the long run, probably not all that much. Unless, like Josh said, unless you have 90% of your portfolio in Chinese companies, probably not the best idea. But yeah, you'd probably be feeling that a lot more. But that's just one of the many reasons why we keep you very well diversified. Okay.
And one thing to chime in on that too is that even if you were able to predict all of these things, you have no idea how the market's actually going to react to those things, right? And we've seen that happen time and time again, in that sometimes bad things happen, and sometimes they're legitimately bad stuff that end up happening, yet the market reacts the exact opposite of what people would think. So just keep that in mind, is that companies, in the end, right, for the stock market, what we're looking at is a big collection of companies, and those companies are going to make decisions along the way And really their stock price is just a reflection of how good those decisions are, right? And sometimes companies that were once great companies, they can't keep up and they make some decisions or lack of decisions, and vice versa. So I just wanted to point that out. Sometimes these different things that can happen in the world, it's difficult to predict, impossible to predict, I would say. And we're also not ever going to be able to predict the result of that, what actually happens.
Absolutely, absolutely. And so really when it, comes down to it, consumer sentiment, if you think about really what goes into making the market, or our economy, is about 70% of what the economy is doing really comes from consumers. It comes from you and it comes from me. It comes from us getting paychecks and buying things like groceries, cars, houses, whatever it is. And so really that's where the ultimate health of the economy is. If people don't have money to spend, they're not going to spend it. So as you can see, the actual consumer sentiment, or what people are feeling is happening in the market overall, is actually up almost a percentage year over year. If we look on the flip side of that, and we kind of touched on this earlier, business sentiment is actually down about 20%. And again, a big reason for that is it's not the fact that they don't have the money, they're just kind of taking that wait and see approach. Whereas they're saying, well, we're in this business and these tariffs might affect us in such a way. And so they're not really willing right now to put their money where their mouth is and say, well, let's run with it this way because we don't know where we're going to end up when this all settles out. And so that is definitely affecting some things. I think that's a part of why we're kind of seeing, on this next slide, we're seeing a bit of a slowdown in GDP growth. Inflation is fairly flat, still very, very manageable. And again, unemployment is maintaining really that low rate for the past 50, 60 years. And so really what we're seeing is, people that want jobs, have jobs, they're working, they're making incomes, and more importantly, they are still spending their money. So no matter what the businesses are doing, if they're taking that wait and see approach, really the overall health of the economy is still there. And a lot of these things are just really good indicators.
All right, great. Thanks, Jeremy. And yeah, just to kind of chime in on that too, unemployment it's incredible right now how low those rates are. Even since we prepared this slide a couple of days ago, actually, or may have just been yesterday, that they released the unemployment numbers. I think we had the strongest January that we have in 5 years. So people are feeling pretty good right now. 70% of the economy is just us spending money. So if we've got paychecks, and most Americans aren't very good at saving, so that means they're spending it. And that might not be very good personally for them, right, as far as decisions over time, but that does help the economy, right, when people are buying stuff. So where we may be going, and the key is may, right, because we really don't know where we're going, but we have some guesses. The one thing that we probably hear more than anything from people these days is, so what's going to happen with the elections? What's going to happen to the market if this happens or that happens? And one thing that as we talk to them a little bit more, is they may have some preconceived notions of, if this happens, then that's going to happen, right? So kind of going through these, one of those is the stock markets always go up in a presidential election year. Not true. There's been plenty of election years where the market's dropped. Number two is if the current administration is a Democrat or Republican in a presidential election year, the market will go up or down, right? It could be the opposite. But I can tell you there's no correlation there. And if you're ever in our office, we've got a nice big chart that actually shows you who is in control of Congress, who is in the Senate, to the House, and the president, and everything over the last 100 years. And you'll see that is true, right? When you look at it, you can see there's no correlation. The market's done great under certain Democrats and terrible under others, and same thing with Republicans. And I think if you look over who's been in charge of various administrations over the last few decades, you'll see that. The performance of the stock market predicts who will win the presidency. Again, not true. We talked about Republican, Democrat. There's really neither one of them is more better for the market. In fact, it's probably better if there's gridlock. The market does tend to like that, by the way. If there's a divided political landscape, it's actually good for stocks, not bad for stocks. And that's kind of back to that last slide or two with business sentiment. That's one reason why that might be down a little bit, because there's uncertainty. and businesses don't like uncertainty. They like to know kind of what's going to go on, what are the things that are going to impact their business over the next year or two. So once the elections are decided, my guess is that that sentiment number will go up, especially if we continue with a gridlock situation. Businesses probably will say, great, that's good, because now we know the rules of the game and we know exactly what we're playing with over the next couple of years. So, really, I think it's important just to be ready for anything. The trade war could escalate again, right? Now it seems like things have calmed down, but who knows, right? It's resolved, but only for right now. I fully expect that the thing with China and the US is going to go on and on and on over years. It's going to ebb and flow. In other words, it's not just a settled issue. It's the two biggest economies in the world, and they've got a lot at stake. So there's going to be jockeying back and forth. And the second thing on here, company profits growing, company profits declining, that's going to come and go over time as well. There's lots of reasons why that gets impacted, but it's important to have a portfolio that's positioned for either one. Economic growth versus recessions. Right now, we're experiencing economic growth, and it may be a slow growth, but it's still growth, right? The sun still is shining at the moment, but we could go into a recession when the economy is only growing a couple percentage points. It wouldn't take that big of a shock to put us into a recession. And then certainly bull market to bear market. This is why it's so important not to time the market or get emotionally sucked into these decisions, because you really need to have a portfolio that you can live with in either type of market, knowing that you're not going to be able to predict when these come and go. So some of the trends, when we think about some of the stuff that we're dealing with right now, it's just kind of mind blowing. If you had told somebody 10 or 20 years ago, hey, these are the things that we're going to be facing as business owners, well, some of them are simplifying their returns. Certainly, trying to get stuff back to companies has gotten easier. I can tell you that I actually had this a month ago. Maybe I'm behind the times, but I needed to return a book because it got damaged when it was being sent to me. So there you go. That also tells you how dated I am, right? Because I ordered a paper book to be sent to me. So I still enjoy them. So I got it, but the cover was damaged, right? So went online, contacted Amazon, and they said, no problem, we'll send you a new one. It'll be there tomorrow. And oh, by the way, don't even worry about printing a packing slip or even putting it in a box. Just take it to the UPS store, have them scan this code, and they'll take care of it. And it really was that easy. So certainly that's happening. Certainly increase in sales, reducing porch piracy. That's a big thing. I had that happen to me as well, actually a few years ago at Christmas time. But again, Amazon, this is not an Amazon commercial here, but Amazon, when we contacted them, they said, yep, no problem. We'll send you a new shipment. And it was a lot of stuff, by the way. It was kind of our big ordering binge for the kids and everything. So it was a lot of presents. They said, no problem. And we got it in a couple of days. Everything was there, and they didn't charge us anything for it. So certainly there's a lot at stake for companies to try to reduce that piracy that's happening. There's a lot of other things that are being impacted by all these advances that we're seeing. And certainly a lot more of the workforce is going to the gig economy, which kind of think Uber or DoorDash, if you're people like that are kind of running around doing stuff. There's a lot more people that are involved in that, either as a full-time career or maybe even part-time. I've just asked Uber drivers when I've been in Uber, what they do, and some of them are full-time. Some of them, it's just a retirement job. Some of them, it's just a supplement income. So, but it's not trivial anymore. This used to be kind of a side thing. Now it's contributing almost $1 trillion to the U.S. economy, nearly 5% of our GDP. It's becoming a big deal and is continuing to grow over time. So changes in wealth and productivity, looking out to 2050, which I fully expect to be here in 2050 to see this. But you can see that the positions changed a little bit. China still ends up being the world's #1 economy by GDP. India actually ends up popping up by 2050, largely population growth, by the way. Some people kind of wonder, well, why is that? And that's just because of sheer population. In the United States, still up there, we're still competitive, but drop a notch there. The interesting thing is some of the other players, though, is Indonesia, Brazil, Mexico. Again, a lot of this is because of population growth. These economies are growing faster, and so they're going to have more and more influence over time. That doesn't count us out by any means, but just the players will continue to change, and the business environment will continue to change over time. So this is from Schwab, thinking about 2020. So what's going to change? What's going to tip the scales? Is it going to be that trade uncertainty and weakened manufacturing hurt our job growth, which we talked about before? That's a huge deal. If our job growth goes down, where jobs aren't being added, or actually see mass cuts like we did back in the financial crisis, could that drag down the economy? Well, absolutely. That would have a huge impact when 70% of your economy is consumer spending. If those consumers don't have paychecks, they don't have the money to spend. And certainly they're going to have to start making choices like they did back in the financial crisis. Interest rate cuts, so a trade war, these things are uncertainties, right? At the moment, interest rates, the Fed has kind of forecast that they're going to stand pat for a while, but that could be an issue later on this year, especially if inflation ticks up. So, and again, the trade war, that's going to come and go. We fully expect that that's not a resolved issue. We're going to see that come and go, and certainly will create volatility in the markets. Goldman Sachs, relatively low odds of a recession, but there are things that could happen again, right? I think it was Harry Truman that said he wished he had a one-handed economist because he said, on one hand, right, this and that. That's what you tend to hear from economists is on one hand this, on the other hand that. So really, there's a lot of other factors out there with regard to the government debt and deficits could definitely have an impact in the future. Say if we have another shock event or recession, there may not be as much that they're willing to do to deliver stimulus. Same thing with the Fed. If rates are really low already, they may be less empowered to be able to lower rates. So no matter what happens, again, we kind of talked about this at the beginning, just being aware of your own biases. And Jeremy and I need to be aware of our biases too, right? So we're asking lots of questions and certainly questioning certain beliefs and strategies and things. We always do that because we want to be open to new information. We want to be focused on what really matters instead of the stuff that's maybe gets headlines, right? The media is always going to be about headlines and what will get us scared and wanting to watch. But at the end of the day, is that stuff that we really want to focus on and put our energy into? No, most of it really doesn't make that much difference in the long run. Remember, losses are part of investing. Really, every few years we see a big drop in the market, and sometimes it's short-lived and sometimes it lasts a long time, like we saw in the financial crisis. But just being aware of that, it's kind of like being on an airplane, right? If you know you're flying on an airplane, it doesn't matter how skilled the pilot, if it was a pirate, different experience. But the pilot could be really experienced and you're still going to have turbulence, right? They could try to go around thunderstorms, they can change their altitude, but at the end of the day, they don't know, right? They don't know and they can't control it. So you just have to experience that that's part of the deal, is that you're going to have turbulence, especially if you're landing in Denver. Pretty much every time you're going to experience turbulence when you're landing. Recognizing the complexity of the modern world, and this is not always negative. I mean, think about the innovation that's happened over the last 10, 20 years. It's incredible. Now you think about the next 10 to 20 years, think about the technologies that we're just kind of hearing a little bit about right now, but they're already being used and are all going to converge here to have a massive impact on the way that we live and the way our businesses and governments interact. Think about artificial intelligence. That's really just in its infancy right now. And be able to take all this information, right? We just have had the information economy for the last couple of decades. Well, what if that information was used more and more intelligently and organized more intelligently? Blockchain technology, certainly implications there for security. 5G, certainly the pace and the speed. That's why there's such competition between different nations right now of who can be the leader in 5G, because of the massive increase in the amount of information and the speed of information that will be able to be flying around. And then, 3D printing, they've actually successfully now, I don't know if they've actually been able to implant one, but they've actually successfully 3D printed organs now. And you start thinking about the implications of that over the next few decades. Once they get that fine-tuned, organ donation will be a thing of the past. People will not die because of that anymore. And certainly because it's our own organ, right? We won't be rejecting it. So just one thing, and that certainly would have a lot more people living and with a higher quality of life. And that stuff is going to happen. These are not just dreams and things that we think are going to happen. They are going to happen. So certainly being open to that and knowing that there's a lot of good stuff, not just bad stuff. There is about a 17-to-1 ratio of negative to positive news stories. And I think if you consume any media, whether it's liberal, conservative, neutral, if there is such a thing, if you read the newspaper, you're going to find that's about true, about 17 to 1 negative to positive news stories. And that's not because, I think anyway, that's not because there's 17 times more bad things than good things happening in the world. It's just the nature of media. So just be careful about what you're consuming and go into it with eyes wide open. Recognize that everything is not just bad. There's a lot of good stuff happening out there too. So with that in mind, we'll turn our camera on again so you can see us, and we'll check to see if we've got any questions. So certainly if you haven't asked them already, please go ahead and ask some stuff, and that'll give us a good challenge for today.
Absolutely, yeah. Haven't seen anything yet, but we do have the chat feature and the questions box there, both. You can use either one of those to send us whatever questions you might have.
Yeah. And while those are collecting too, I just think it's important that people stay educated. That's why we do stuff like this, is because we want to make sure that you're informed and that the only thing you hear is not from the mainstream, media, right? That's focused on the negative stories. We want to add clarity to what's going on and just to add another viewpoint so you can see kind of how this might impact your money and it might impact your decisions going forward. So
maybe we just did too good of a job.
We might have. That's very possible.
Yeah.
Which, thank you. If that's what you're all saying right now, that feels really good. Thank you.
Right.
But certainly we're open for questions. We always have an open door to be able to jump on the phone with you or have you come into the office. But just know that right now things are looking pretty good. Prediction, by the way, I think based off of all the strategists, the experts, we think 10 to 12%, right? The S&P 500 probably 10 to 12% this year seems pretty reasonable, but nobody knows, right? That's just our best guess based on the information that we know now. Should be a decent year, probably not as much growth as we saw last year, but still growth and still an expectation that we're probably not headed into a recession. Ray Dalio, who manages the largest hedge fund in the world, by the way, so it's somebody to listen to. He's had a lot of success over the decades, is that he says in any given year, there's about a 20% chance of a recession. So regardless of who's in office, regardless of what's happening, there's about a 20% chance in any given year that we're going to go into a recession. So nobody knows when that point is going to be. That's why it's so important to plan, why it's so important to sit down with somebody. If you're not an expert, and you're not wanting to be an expert, then it's important to be partnering up with somebody who is, because right now, again, the sun is kind of shining, right? I think everybody's feeling fairly good about the markets and the economy and everything, but it's not going to last forever. We know things go in cycles. So now's the time to really assess everything and make sure that you're positioned so you're not left caught off guard when things change, when the environment changes.
Well, I don't see any questions or comments or anything of that nature, but as always, you guys can always reach us as well. If you're watching this after the fact on our YouTube channel, you can always reach us at Jeremy@keystonefinancial.com or Josh@keystonefinancial.com. We're always happy to answer your questions and help you out however we can.
Yeah, and certainly keep an eye out for more webinars. We're also launching a podcast here at the end of the first quarter, so be keeping an eye out for that as well. We just want to make sure that we're communicating and that we're giving you lots of opportunities to learn, because we think that when people are informed, it's an opportunity for people to just understand better, and they're likely to make better decisions if they're informed. So thanks for being here today. Thanks for giving up your hour, certainly, and thanks for the trust that you place in us.
All right, take care.
All right, have a great week. Take care.